Hi, good evening. My name is Tai Wei, and I'm a proud Boost 95 graduate. Thank you. So welcome to the second annual Economic Outlook event in Hong Kong at our wonderful new campus here. This Economic Outlook event is a Chicago tradition. First established in 1954, that's 66 years ago. This is what our website says about this event, so I'm reading this. Drawing on Booth's culture of unparalleled inquiry, this annual event provides a forum for our path-breaking thought leaders to confront the future, evaluating emergent trends and sharing key insights that help reframe our understanding of the world to come. All very big words, okay? Also sets a very high bar. So to keep up this proud tradition, we have a lot to talk about tonight: big tech, trade, central bank, and global economy in general. But before that, before we get too deep into all these big topics, we have a little commercial. We have an Asian Forum event on February 15th on this campus. This is a collaboration between the University of Chicago and Chicago Booth, and it's an event for, inaugural event for the campus. Space is very limited, so please register for the Asian Forum event ASAP. Now let's get back to our big topics today. We have three distinguished speakers. Professor Randy Kroszner, who is Deputy Dean for Executive Program and Norman Bobbins Professor of Economics at Chicago Booth. He was previously a governor of the Federal Reserve System. Also with us, Professor Brent Neiman, Edward Eagle Brown Professor of Economics, and previously a staff economist on the White House Council of Economic Advisors. Also with us, Professor Richard Wong, Provost, Professor of Economics, Philip Wong, Kennedy Professor in Political Economy at the University of Hong Kong. And more importantly, he is someone who has BA, MA, and PhD, all from University of Chicago. That's a lot of Chicago degrees we're talking about here. So, and joining the three professors is our event moderator, Angie Lau, Editor-in-Chief, CEO, and founder of Forkast.News. So let's have a warm welcome for Angie and our speakers.
What a wonderful privilege it is to be returning to this stage with whom I regard as some of the top minds in economics today, not only in this region, but around the world. So I had the privilege of really moderating and guiding this conversation last year, and I'm thrilled to return this year because there were a lot of things said last year that really set the foundation of understanding that really, actually, you guys called, frankly, with great accuracy. As I'm sure, just like all of you, starting our day off, trying to figure out what this US-China trade deal in phase one is going to reveal to us in the coming hours, and waking up to Randy, and really guiding the thinking. So let's kick off there. I think it's the most timely. It continues to be top of mind for this region, top of mind globally. And so where are we 12 months later? We're still talking about US-China trade relations, except this time we seem to have gotten a deal, a phase one deal of which 86 pages you'll be reading a little bit later on, right? The significant part of it, I think we know. The one thing that really surprised the market, and what is reflected in futures tonight, US futures, is that a significant part of the tariffs will remain in place until 10 months from now, upon review from the US administration, current, pre or post-November elections. So I want to generally kick things off there. In your view, where does that set us up? Is this really a reset of relations? Are we finding sturdier footing? How should we be thinking about this?
So I think it's an excellent step forward, but I think it's a small step because of exactly the issues that you mentioned. The bigger picture issues about intellectual property rights, about the way the regime operates and such, that's going to be there, and that's going to still be very much top of mind. Also, the way things will likely work with the agreement is that there could always be a return of tariffs, but even in the beginning, it's not even a step to take the tariffs away. It's just a step really to start negotiations about other things. So I think the direct economic impact is going to be relatively small. Even if you did remove the tariffs initially, the economic impact on the US would be relatively small because trade is a much smaller percentage of GDP than it for China than it is for the, much lower percentage of GDP for the US than it is for China. And so then you're just looking at the Chinese fraction of that, so it's a fraction of a fraction, and then tariffs that might be 25% on that. So it's a fraction of a fraction of a fraction. So for certain particular industries, it's very important. And so I don't want to downgrade that, and I don't want to be misconstrued as saying it doesn't matter to anyone. But if you look at the overall US economy, it's relatively small, much bigger impact on China. And I think the lack of, the unwillingness to pull those tariffs back at the beginning is very suggestive of how the agreements are going to, or how the negotiations will continue. I think there's not a deep level of trust by the US administration with China. I think there's some trust because they're getting to an agreement, but they really want to, in some sense, do the trust but verify, keep the tariffs in place until they have proven that they are going to be working with the agreement, rather than saying, we got to the agreement, so we're going to try it out, then if something goes wrong, we can come back. So I think that's likely how things will continue to be. Very small step forward, positive that they can get some sort of agreement, but I don't see it making, in and of itself, having a big economic impact.
Brent, you did some really interesting work taking a look at the short-term impact of the tariffs on U.S. retailers and manufacturers. What did you find? What, in terms of, as to follow Randy's point, the impact, generally speaking, on U.S. economy might be fractional, but specifically on retailers, that is a different story.
So I'd love to take a step back for a second and think what it might mean, what it might look like to win a trade war. So this is a phrase that was used a lot. And one objective of any country putting a tariff on its imports is essentially to get the price charged by the foreign exporter to go down. The goal in the extreme, I mean, the way that you would really win a trade war would be if you put a 10% tariff on and the price charged by the foreign exporter goes down by 10%, the two cancel each other and your consumers face no change in what they pay. And the only thing that's happened is that the profits that the foreign exporter were earning are shifted to your government's coffers. That's called a terms of trade improvement that, in theory, you're trying to induce when you put tariffs on imported goods. And so the key question, one of the first things that an economist would want to look at when understanding the implications of these tariffs, whether it's working or not, quote unquote, would be to look at the price charged by exporters on those goods shipped to the US, in this case where the US put on tariffs. And so together with some co-authors, Gita Gopinath and Alberto Cavallo and Jenny Tang, we got access to very specific microdata that allowed us to look at goods as they crossed the US border that were hit by tariffs versus not hit by tariffs. For instance, the equivalent goods sold by China or not China. And what we found was that the price paid by the importer, inclusive of tariffs, went up almost 1-to-1 with the tariff. So a good that faced a 10% tariff cost the US in total, the importer, 10% more. So in no sense, were we moving the terms of trade in a way that would benefit the US. That was one of our findings. The second finding, and there's really three I'll focus on, was that when we looked at the retail price, we actually found much more muted differences in the pricing behavior of goods that were affected by the tariff versus equivalent goods that were not. So how can it be that you see a big effect at the border and almost no effect in stores? Well, the answer is retailers were absorbing quite a bit of it in their margins. One reason I think this is both important and interesting is it suggests that the long-run response to these tariffs has yet to be seen. Even if tariffs were to stay exactly how they are for a while, I would anticipate more adjustment where retailers came to terms with what the long-run price of their inputs were going to be and potentially passed a lot more of it through to their customers, which certainly could matter for the political dynamic and support for import tariffs as well. The last thing that I'll focus on that we saw that I found quite interesting was we did the exact same analysis on US exports to countries that retaliated on the US, in particular China, but other countries also retaliated. And interestingly enough, there we did see that US exporters were cutting their prices before paying before including the tariff that would be put in by the other countries. So in some sense, on the import side, there's no evidence that the US moved the terms of trade in a way that helped it. On the export side, there is evidence that US exporters were quite significantly bearing the cost of retaliatory tariffs. So in that setting, Randy's right, this is not an absolutely gigantic share of the economy or anything like that, but I do think there have been real damages on the economy from the trade war. And even as importantly, I think we haven't yet seen how it will actually settle in terms of the distribution of those damages to consumers versus firms.
How do you think overall that's going to shift business behavior and decision making?
Sure. Well, one thing we've already seen is trade diversion. Quite obviously would be accelerated by a policy like this. And you can actually see very clearly the volume of imports from China have fallen quite substantially in response to these price effects. The elasticity estimates are not very low in studies that have looked at the response. And so, yes, you could see a permanent reorganization of certain supply chains, which could have very much lasting effects, even if tariff rates were to revert to the levels that they were at before 2017, let's say.
Richard, you being based here in Hong Kong, you've observed, we've all felt the impact of the US-China trade tensions, and observing that here in Hong Kong and also across the region. How do you follow up on Brent's observation that, that is shifting the dynamic of business decision making and impacting us right here in Asia?
I think the impact is significant, and we haven't seen the tail end of it. Right? I think there are several factors, and unlike Brent, I haven't done empirical work, so it's more conjectural and perspective. Unlike traditional trade, this is a global supply chain reconfiguration, because much of the growth in trade in Asia is actually inter-regional trade, transshipment, re-exports. So all this reflects basically a product moves across several borders within Asia before they end up, say, in the United States or in Europe. Now, when you impose tariff on China, and when China responds with tariff, the global supply chain reconfigures. The reconfiguration depends on how long you anticipate this animosity between the two countries will last. Now, this has gone on for some time, so I think the perspective is that it will probably be it has set in, people are more determined to reconfigure supply chain. This has already happened, and you will notice that some of them have been reconfigured towards other Asian countries.
Who are the big winners?
Vietnam will certainly be a significant big winner, but so are others in Southeast Asia and in Northeast Asia. Well, Northeast Asia will just be Korea. And given the recent elections in Taiwan. Prior to that, there has been policies to attract industries back to Taiwan. So it's been, but the other thing is some of it would have been reconfigured anyway, right? Because China's labor costs are rising.
Right, that's a great
right?
point.
Right, that's one of the reasons. So it would have been reconfigured. Teasing that out would be important. And finally, is that until the future becomes more settled down, I think there will be just more incentive to reconfigure, right? Now, not all this, and then it will also depend on monitoring and enforcement and verification mechanisms about, origin, value, content. So it's a pretty complex process. This reconfiguration. It is not something that you could easily see. But I think the process, as I observe it, by talking to people, looking at some data, but not doing the kind of estimation that Brent has, it is going on. It is going on at a reasonably rapid pace. So this is the permanent change. It affects Hong Kong, definitely, because the chain is reconfigured.
No, it's very interesting because I was just in Shanghai and talking with both people on the finance side as well as the real economy side, and you definitely heard exactly this sort of thing, that they're moving out of China. Now, and exactly as Richard had said, that was gradually happening anyway, partially because of the higher wages. And so 20 years ago, China used to be extraordinarily an extraordinarily great place to do manufacturing because you had very inexpensive labor and relatively high productivity labor. But now that the labor costs have gone up, but the productivity costs have not gone up commensurate with that. And so there's been a move to Vietnam, Malaysia, Indonesia. And so in talking with people, what you hear, and I think that's, and it's consistent with broadly what we observe, is that this had been gradually going on, but the additional uncertainty of whether tariffs could come back and the actual direct effects of making things more expensive is accelerating that trend. So no one's opening a new manufacturing plant in China now. They're opening them elsewhere. No one from the outside is doing that. But there's also an interesting piece that doesn't get much attention about the consequences of this for China, is that they have now become worried that they might not have access to certain types of technology. Mm-hmm. And so it's led them to think about trying to invest in national champions for semiconductors, for other things. So there's another type of response that doesn't get as much attention, but that was also a lot of the discussions with the people that I had there about how the Chinese government, which directs a lot of the investment in the Chinese economy, and China is has one of the highest investment rates around the world. That's been redirected towards trying to build up some of these domestic strategic industries that they worry could be excluded from US technology or Western technology. So you've got sort of an interesting combination of things that are happening both on the foreign manufacturing moving out, part of a trend that it was before, but now investment in some more of the tech sectors by the Chinese government. And in some sense, that's broadly where they wanted to go anyway, because they faced the classic middle income trap. They've grown super rapidly from being very poor to being solid middle income, but very few countries make it from middle income to the high income. They've been wanting to do that through having more high value added types of firms rather than just a piece of a transshipment puzzle. And so this is actually accelerating that trend. So it's a fascinating combination of factors.
Before we potentially head away from trade, I did want to just build on, Randy used the word uncertainty. And I think there's one really beautiful study that explains, that sort of identifies, to me at least, why trade uncertainty can be so powerful. And that's thinking about China's WTO accession. So there's a famous study that notes that in the late 90s, early 2000s, before China's WTO accession, China actually faced the same tariffs placed by the US on its imports from China as afterwards. It's not as if when China entered the WTO, it reduced the tariff that it faced when it sold into the US. Instead, what it did, the consequence of that accession, was that it meant that the US government didn't every year have to re-vote to reauthorize that low tariff rate. And so before the WTO regime, there was a lot of uncertainty. Would this be the year that those tariff rates hiked up. And after the WTO accession, those low rates were guaranteed. But that was the only change. The actual rates themselves didn't move. And yet studies have shown that industries that face this change in uncertainty had a big expansion of their exports to the US as a consequence of entry. And the reason I bring this uncertainty up is I do think that one of the major repercussions of this recent trade war has been the elevation of uncertainty. We can actually measure it. My colleague at Chicago Booth, Steve Davis, for example, puts out an index of economic uncertainty that's at very, very high levels historically. And if tomorrow, and we know that this is not going to happen with the Phase 1 truce, but even if the Phase 1 truce did revert all tariff rates to their pre-trade war levels, I still think there would be a drag on the global economy, certainly a drag on trade, coming from what I think is going to be a persistently high level of uncertainty. I assume none of us thinks that this issue immediately goes away and has any great confidence on which direction it will go over the next 12 months, let's say. So I do think thinking about uncertainty is also quite important.
Just one very short point. I think measuring the cost of uncertainty on trade and the disruption of the trade policy uncertainty environment, one must be very careful not to use old-style trade war models that I learned when I was a student, because the old-style trade models suggested you produce everything in your own country and you ship it. Now you have a global supply chain. So the uncertainty and the disruption, and therefore the costly consequences, are much more likely to be much more significant.
I guess that's where the political tensions lie, because it seems that current U.S. administration is very still playing by that playbook there in terms of returning manufacturing base to the heartland.
Absolutely. I would certainly think so. But the key there is, to a large degree, there are two issues. It's easier to know that it will hurt pretty much everyone to some degree, or an unknown degree, but they will hurt. It's much more difficult to say who will specifically be benefited as a consequence, because very often it requires a level of information that is very micro and probably not easily collected. And that is what I think. Therefore, so bringing jobs back, who knows what does that really mean? If you were to bring the industry back, does that mean the job comes back? Right? That's another thing. You need not be hiring more workers in that same industry, in the same region that was doing the same thing before it moved out. Right. So I think that those consequences are much more difficult to estimate.
Randy, what's your perspective, the observation to follow this? We have the strongest jobs rate in 50 years in the U.S. We have Peter Navarro, White House trade advisor, saying that the traditional economists have gotten it wrong, that there are actually benefits to the U.S. economy. Having said that, what are they? And in fairness to what we're seeing in the jobs rate, it is the strongest we've seen in half a century.
For sure, and so I think I would agree that I think overall, at least in the short run, it is not helpful to have tariffs on, and so it's held us back a little bit. But as you can see, it's not an enormous drag on the U.S., at least right now. The longer run consequences, I think, the ones that are really quite interesting to try to work through. So there's the uncertainty issue that Brent was emphasizing, and that's been part of a broader issue that one of the puzzles post-financial crisis has been how little investment we've seen, not only in the U.S., but in countries around the world. You would think with extremely low interest rates, both real and nominal, and commitments by central banks to keep interest rates low, and they have done so, that you would see, well, gosh, and look at, so much of the world has negative interest rates. It's pretty easy to come up with projects that lose a little bit of money. And so you would think that, if you can get finance for projects that lose a little bit of money because they've got negative interest rate, you'd find a lot of people like taking chances on things and doing a lot more investment. But we haven't seen that, and that's not unique to the US. It's true in the UK, it's true in continental Europe, it's true in emerging markets. It's not true in China, where, as I said, it's sort of state-directed investment. So that has, but that's obviously is not a market-driven phenomena. And so additional uncertainty may make businesses continue to be very wary of investing. We've had this astonishing recovery with relatively low investment, but for it to sustain itself, at some point you're going to have some investment, and so it may weigh on that. Now, on the other side, someone like Peter Navarro and people in administration would argue that this is sort of a much bigger issue than just something about soybeans and cars right now. It's a geopolitical, geostrategic, and potentially military might one. And so, and also an intellectual property theft one. That's what they would argue. And so taking those actions now will help to reduce some of those costs in the longer run of trying to be able to, or anyone else be able to become stronger by not enforcing intellectual property rights, by taking away innovations that are done in the US or elsewhere. That, of course, would reduce the incentives for those innovations to occur going forward. And so that could have a negative impact. It could also be used to strengthen the geopolitical power of China in a way that potentially in the long run could be harmful. Do we have answers to these? No. Do we have it's very difficult. Even Brent's unbelievable brilliance in finding data for things, I don't think there are enough observations historically for us to be able to look at this. But my guess is if there's anyone who's going to figure it out, it's going to be Brent to be able to do it. And so this gets into the realm of much more kind of punditry and speculation. It's not unreasonable to think about those trade-offs, but it's very, very difficult to be concrete about them. But I think that's the bigger picture issue that is raised, and so it makes me more concerned about sustaining the recovery, for sustaining growth over a longer period of time.
That is a very interesting dynamic that you've observed with when the job market is that strong, and yet we are not seeing a return to business investment in the United States. That should reflect and mimic that characteristic. Brent, in your view, in your work, as you take a look at the behavioral aspect of the labor market, what should we be seeing, and your perspective on this against the global backdrop?
I guess the setup to the question that you discussed with Randy was that the labor markets are exceedingly strong in the U.S. right now, and they are. I think it's important to ask, I guess, a couple questions. One is this a trend? Is it a deviation from trend? When did it start? My sense is that the effects of the trade war and the labor market shouldn't be so obviously connected, certainly at high frequencies. If you look at the slow, steady improvement in the U.S. labor market, it's not obvious that we want to think of it in terms of a year or two as opposed to a much longer, steady improvement. So in the short run, when I think about the effects of trade or barriers to trade, I think about issues like how productively are we producing our goods? Are we sourcing them from the most effective producers of those goods globally? I mean, the world is a machine for making output that we all consume, and if that machine uses its inputs as efficiently as possible, we all get to consume more of it. And it's a very common reaction, I think, for the world to associate trade with labor markets, and certainly politically, when Nafta was sold in the U.S., it was sold as all about jobs, for example. But I think trade economists are much more likely to connect the effects of trade with wages, with productivity, than with something like the number of jobs. And when we talk about the labor market being so strong, it's really by count. It's the unemployment being so low. Not that wage growth is taking off or inflation is spiraling up out of control. It's just that employment is rising, participation rates are coming back. So I would be hesitant to learn much about the implications of these tariffs from the recent job market in the US, which absolutely looks pretty good.
And that's why the audience is here, because how do we think about it beyond the numbers, beyond the headlines? As you've said very critically, what are the wages? Is there wage growth? Is there actual inflation? The fact that the Federal Reserve has kept it traditionally low levels and unable to sustain a 2% inflation rate, that is also reflective of this broader conversation.
So I think I'd like to comment a bit about it's the issue of policy uncertainty, because it's not just trade policy that has become uncertain, and because U.S.-China trade wars is part of that, and there's also geopolitical uncertainties. But there are many. Ignoring all that, if you look at most mature economies, including that of Hong Kong, okay, we have a fundamental loss of trust in government. It has declined over time. Now that is sort of, in my view, it looks like a mirror image of policy uncertainty. Maybe the government is doing exactly the same thing, but we just don't trust it. That is actually uncertainty in at the other side of the equation. And I think that is growing in many parts of the world. Certainly, I think, including Hong Kong, as you all, I'm sure, agree. Now, all this makes it that even though unemployment in many parts of the world are pretty low, Hong Kong has been 3% for a very, very long time. And US has recovered remarkably from based on historical record. And yet, I think I want to re-emphasize what Brent said. Wages for most people does not grow very much. And there is something that has fundamentally changed in terms of the shape and the composition and the structure of the industry. And that leads back to, I think, to technology and maybe a host of other factors that we can all think about. And this has created, and the correct understanding of that is not actually abundantly clear to many people. And I think that has fueled, and what government has promised to fix is very limited and very often fails to deliver, or doesn't have the funding to do it. Hong Kong may be the only exception. So they have the reserves, so they are throwing a couple of billion, away very quickly. But for most society, you don't have that option. And I think this too, actually, in my view, this general malaise, lack of trust, uncertainty, because we don't really understand exactly what is happening out to the economic structure, and therefore don't trust government who has promised many things and fails to deliver. I think that is in my I am not a forecaster. But what I try to do is I look out my window every day and I see what do I notice. And I see a lot of people feeling rather uncertain about the future. And when I look out the world didn't change very much. It's just that graduates today cannot look forward to a future in the same way that my generation could look forward to a future. Now, that discourages everyone, I think. And I think that feeling is around in many societies that are mature. And I think that is the mirror image of Steve Davis' view, which I really admire. I mean, his index of uncertainty is very important. It's one of the real contributors for understanding what's happening, or a tool for helping us to understand the world.
Well, policy uncertainty, political uncertainty, economic uncertainty, and then there is one function that central banks around the world try to stabilize is the monetary, at least, and economic instability, and try to absorb the shock of it, to the best of its ability. And the ability of that seems to be, in terms of firepower, waning. We take a look across global central bank action, and you have the Federal Reserve in the United States forecast, or pretty much we expect to see no, according to the dot plots, no rate hikes in 2020, to be debated, of course, here amongst the panelists. But we also have negative rates around the world, including, of course, ECB and Bank of Japan continuing negative interest rates. In this scenario, what is the role of central banks to try to absorb and to stoke the kind of growth that we should be seeing? Inflation often is a bad word, depending on how you look at it, but it's something that is part of a healthy global economic backdrop. It's not something that we're seeing.
This is an incredibly challenging time for central banks. At least for most countries right now, the challenge is not inflation, but very low inflation or deflation. So that's a dramatic change from, if we had had this 15 years ago, the idea that everyone would be worried about low inflation and deflation for central banks, that would have just seen as preposterous. It all would have been about trying to rein in central bankers who are getting political pressure to inflate or to just sort of, kind of go crazy in that direction. And now it's exactly the opposite. And in part of it is the DNA of central banks is not well suited for that. So their very natural, very cautious way of speaking and acting, at least pre-crisis, has in some sense made some number of central banks perhaps less effective. So like Bank of Japan, let's take that as an example since we're here in Asia. You have Abe become elected, and so he makes this salient for everyone. So it's not just an aficionados thing or people who are in the markets. He says 3 arrows in Abenomics, and one of those is fighting deflation. He then puts in Kuroda-san as the head of the central bank. Kuroda has a very well-known reputation for saying the Bank of Japan has not been doing enough to fight the low inflation and the deflation. It should be doing much, much more. He gets in and he has his moment a little bit when Mario Draghi says, we'll do whatever it takes, and believe you me, it'll be enough, and the markets believed him. So Kuroda-san gets in and says, I see that there's no limit to quantitative easing, to asset purchases to be able to fight the deflation. Unfortunately, he does not have the same impact on the markets and on inflation expectations that Mario Draghi did, particularly on expectations about what would happen in Europe. Because you see with Draghi's statement, just a real collapse of interest rates, the risk spreads for a lot of, especially the peripheral countries, Portugal, Spain, and others. And the Bank of Japan has been struggling, despite Kuroda trying incredibly hard. I mean, the balance sheet of the Bank of Japan is now more than GDP. At the peak in the US, it was about 25% of GDP. The ECB is a little bit larger than that and is now going to be on another growth path. Just completely off scale. He's doing exactly what he said he would do and can't seem to get inflation to be close to the target. And so I think central bankers have to sort of sit back and think much more carefully about whether that's a useful tool or not. And this gets back to the uncertainty issue. Committing to negative interest rates for a long period of time, like in Japan, does it increase or decrease uncertainty? So from the Bank of Japan's perspective, and I think from traditional kind of so-called inflation targeting perspectives, that should provide a lot of uncertainty because the Bank of Japan didn't have a particular inflation target before. Kuroda gets out there and says that really trying hard. He's not saying one thing and doing something else. He's saying one thing and literally putting his money where his mouth is, or putting all of the taxpayers' money of Japan where the mouth is, and he can't succeed in getting that forward. And so I think, and we could talk about this a little bit later. In order to generate greater certainty, what do they need to do? And I think they actually need to speak in a different way. What traditionally central banks have done is, they think about this inflation target. They say we have a 2% goal, and because everyone listens and respects the central bank, if they announce it, everyone believes it, and they change their behavior. Well, we've seen that globally. That's not the case. ECB has a 2% inflation target. The Fed announced one in 2012, has not met it once since 2012. Obviously, Bank of Japan has had this enormous challenge. And so often the response is, oh, we need to like improve financial literacy or just speak a little bit more clearly. But I think that the better approach would be to get out and try to understand how people are thinking and then work back from that. So in your packets, there's a lunch with the FT with Richard Thaler, our most recent Nobel laureate who focuses on behavioral economics. And actually when he was here last year at the grand opening of the this spectacular campus here, he mentioned, and I also talked about this privately, when he came to Chicago 25 years ago, he thought the big success of behavioral economics was going to be in macroeconomics, because there was so much about inflation illusion and so much about these kind of behavioral things. They thought that's where it would be natural. But of course it wasn't there. It was in finance where it sort of took off. And I think central bankers need to become much more behavioral economists. Go out and work from what do people hear or think about when you ask them about price changes or inflation, and then work back from that, rather than just try to say more loudly, well, this is 2% and it's really 2%, and believe us. Well, clearly just by repeating it, they haven't believed them. So I think you need to do it in a different way, and I think starting from what people understand and how they think about, and this is all amenable to field experiments and a lot of stuff of what we do at Chicago now that Richard has been so important in generating. I mean, when he got there 25 years ago, and when I got to Chicago 30 years ago, there was nothing about that kind of stuff. Field experiments were not something that economists did. Now, I would say a near majority of the junior faculty on both economics and finance do that kind of thing. But I think we need to do it on these issues, and so far central banks have not done it, and none of the faculty have done it yet.
In journalism, we call it go talk to the man on the street.
Yeah.
You got to do more man on the street conversations. But Richard, what does the man on the street, woman on the street really think?
Well, this is, take me as a man on the street.
Okay.
Oh, come on, Richard.
Okay, so I studied economics in Chicago in an era when inflation and hyperinflation was the concern and was the worry. We learned from Friedman and many others that this was the problem. And the issue was to get it down. You need a monetary rule, and then you need to stick to that rule to reduce policy uncertainty. That's what we learned. That was the holy canon, right? I mean, that was it. And then, and I had been to Peru when they had hyperinflation. So I really witnessed hyperinflation. That taught me something which the textbooks didn't, because the textbooks were formulas and concepts, and that was really physical, right? So I really had a personal experience during that time. And then many of you here probably lived through the period from after the Asian financial crisis, right? 1997 to 2003. And did you believe it? We experienced deflation. Cumulative deflation over a 6-year period was 13%. Now that is very serious. The only time it was more serious was the Great Depression, right? Now, going through deflation, now, a 1% inflation is basically, taking into account, it is basically no inflation, right? It's very close to no inflation. Now, when you don't have, this is my man in the street, if you don't have inflation, I think it's just bad for business. I mean, you don't need to that's not what Chicago taught me, right? But that's what the man in the street taught me. Inflation is always good for business because they are always sleepy guys, right? Nobody sees the future perfectly. That's the micro businessman's view. Now, if all of them think this way, it has at least a short-term self-fulfilling prophecy, if not in the long run. Now, this is the problem. Going through deflation is really very destructive. It creates huge inequality, loss of faith in government, and worse, a whole generation of young people become extremely risk averse. So risk averse, they are not willing to become entrepreneurial. This is the man in the street as a teacher now. I've seen my student who lived through that period became extremely risk averse. By the time the economy recovered, they were still not convinced. By the time they were convinced, they were too old to take risks, and they were already burdened. Now, I see that in a generation of students. I've taught in Hong Kong, I mentioned, over 43 years. So I can really testify that people who were late 20s during that period basically gave up their entrepreneurial future for those who were my students. I could witness them. Now, so deflation is really now even low inflation is just a moderate way of thinking through that idea. And I think not being able to get prices to go up, the golden rule, at least in Chicago during freedom, was at least 2%, right? But probably not more. But we are so far from 2%. In many parts of the world, so far from 2%. So this is I think there is something, I don't know how to fix it. Randy, you are the governor of former governor. Getting inflation up
it's not
is
all
really,
my fault now.
getting inflation up at least 1 or 2% is really a very important objective. And I think somehow we have failed to do that. And I think from a man in the street, a businessman, why would I mean, sometimes, wrong micro decisions can be saved by good macro policy, right? Not in the long run, but at least in the short run. And taking risks, this is back to behavioral economics. Maybe that kind of psyche might be relevant.
So, we're seeing that. Central banks are trying that. Federal Reserve is doing that with trying to stoke risk, right? Even costing you, if you save money, it's going to cost you, so please spend it, right? That is the kind of behavioral outcome that central banks are trying to stoke. On the other side of it is a real huge global growing concern about debt. Sure. And growing debt bubbles, as you said, Bank of Japan carries more debt than its GDP. We're seeing that increasingly in China, obviously, with concern there. Where does that leave us for those who are watching this debt pile grow and still seeing lack of inflation? So what's not happening? What needs to trigger? And are central banks the ones to do it?
Well, this is one of the potential worries. So when interest rates are extraordinarily low, debt service costs are much lower than they otherwise would be, so people can afford more debt than otherwise. But that's an extraordinarily important qualification, that when interest rates are low, if interest rates suddenly rise up because people lose faith in the central bank, now it seems like inflation is completely off the table. No one thinks that there's any possibility of an inflation spike. But we know that inflation can still occur. Look what's happened in China. You've got relatively easy monetary policy, and then you have a particular shock in a sector. And so measured inflation has gone up quite significantly in China. If you look at the core, not nearly as much, but there still has been movement up. And so inflation can occur. And so if there is a significant movement up in interest rates, this could be devastating because the larger debt burden couldn't be repaid. And so that has become an increasing risk. Not that I think that that's likely in the next year, but at some point the bond vigilantes will come back from the grave and say, can they really pay all this stuff off? I'm not so sure. And then as interest rates rise, it becomes more and more likely that they can't pay it off. It becomes self-fulfilling, and you can get something that is quite devastating. I don't think that's in the very near term, but that's, I think, a longer-term worry of these very low interest rate and negative interest rate policies.
Brent, in your work, are you finding that behavior, I guess, on the U.S. side? Does the strength of the U.S. dollar almost make make America immune to this behavior?
Yeah, so the United States, both government debt situation, but the country's net credit position, or net debt position vis-a-vis the rest of the world has been quite puzzling for a while. The United States runs trade deficits now for decades, for example. and interest rates are quite low despite relatively high debt levels. And one potential explanation, one key factor appears to be the role of the dollar at the center of the global financial system. The dollar is the preeminent, dominant global currency. What do I mean by global currency? 100 years ago, we probably would talk almost entirely about the share of that currency in central bank reserves. But nowadays, we would take a broader, I'd argue more modern approach, thinking about the share of, for example, corporate bonds denominated in that currency, the share of bank deposits and cross-border bank loans denominated in that currency, the share of trade, import and export manifests denominated in that currency. And you might think that the dollar has been the strongest global currency for a long time, and sure enough, it has been. But it has changed quite recently in a way I found quite surprising. In 2008, one might argue, I would argue, that the United States was probably where the global financial crisis sort of emanated from. It was geographically, at least, the provenance of the crisis. More recently, the United States has been the country that presumably would be credited with initiating some of these trade wars, with changing its fiscal stance. And yet, since 2008, the use of the dollar in this international currency role has, if anything, grown. My colleagues and I, my co-authors and I, Maggiore, Schrager and I, for example, show that if you look at the share of global corporate debt that is written in dollar terms versus euro terms, it was quite stable from about 1999, 2000 until, or really a little later, 2003, 2004 until about 2008. And then after the crisis, actually the dollar's share has surged. It went from about 40% to about 70% at the cost of the euro. And you see a similar pattern if you look at international lending, a lot of other uses of the global currency. So there is an argument, I think an empirically backed argument, that the dollar, in terms of its use as a global currency, is stronger now than essentially it has been in decades, in many decades. And I view this as having kind of two repercussions for the question at hand. On the one hand, it might explain, in some sense, why the US has had such low borrowing costs despite relatively high debt loads. If there really is, for whatever reason, this global demand for the dollar as the unique safe asset, well, then it might make sense that the US borrowing cost appears to be deviating from what you'd think of as a historical norm in terms of its relationship with the amount of debt. But the other thing is it presents a risk should that demand for the dollar as the safe asset change. It means that, yes, its position is quite strong, but almost by definition, there's more to lose. It's more vulnerable. And there's actually some evidence that a little bit of that is happening quite recently. So in another paper with those same co-authors, but also Andrew Lilly, we actually show that the dynamic properties of the dollar's value, so now I'm talking about the exchange rate, changed with the crisis. Before the global financial crisis, if you looked at how the dollar moved with risk measures, like corporate bond spreads, like the return on the S&P, like the VIX, you actually didn't see much of a relationship. This was something known as exchange rate disconnect. Academics would talk about how the exchange rate didn't seem connected with otherwise important variables. Since 2008, you actually see a pretty strong connection between the dollar and these risk measures. When measures of global risk appetite go up, the dollar is weaker, and vice versa. Month-to-month fluctuations have moved in lockstep until about 3-4 years ago, when that relationship has begun to wane. So all these kind of facts paint a bit of a hazy picture, admittedly, but one where the global role of the dollar may very well have changed structurally around the time of the global financial crisis, potentially reflecting this global demand for it as the unique safe asset. And to the extent that erodes or even more quickly evaporates, it certainly could cause big problems for the US, which does now have a pretty big debt load.
Richard, from your perspective, man on the street here in Asia, especially after America pulled the currency manipulator label off of China for now, what about the China dynamic? how should we regard the role of the yuan against the backdrop of how a global economy has a relationship with the US dollar, and how that relationship might be shifting, or how China wants to shift even that relationship?
I think as the global economy, as US-China decouples, which certainly most people that I know that I've talked to in Hong Kong thinks this is happening, and this is not easily reversed, will be reversed. It's probably decoupled. It's a question of whether this is happening very slowly, or it will suddenly accelerate, or there will be many attempts to slow it down sufficiently so that, but most people I've talked to feels that decoupling is pretty much the name of the game. All right. Now, if we take that perspective, which is really a pretty negative thing for the long-term future of the whole world, the willingness and ability of China to make their currency more convertible, the capital account to become more open, less restrictive, will probably not grow as the trajectory will be much longer, right? And in that sense, I think whether you call it currency manipulation or not, whether the exchange rate between the two is really an unimportant issue. Because as decoupling occurs, there are much larger concerns that will be looming in the horizon. The unfinished agenda of the U.S. trade talks, those will be very slow. And the longer it takes to achieve any significant progress in second phase will certainly encourage China to go alone, right? Because if there is no future, why engage? Now, of course, that creates a completely different policy environment for China, right? They have to, I would think they would have to think very seriously about at least sustaining reforms within their domestic economy to sustain domestic demand for their own growth, which would be very top of the agenda, right? Because the external side becomes less reliable, and you must rely on internal, what I would call market or reforms to drive that. So I think moving forward, you have to be very cautious about how U.S.-China relations move forward. Phase one is done. Well, will there be phase two? When? What is in it? And what if sustaining interest in continuing it will be very significant for everyone, I would think, because it will go beyond trade issues, widely beyond trade issues. That would be my view. And of course, Hong Kong being in the middle of this relationship, Milton Friedman saying, this is always a difficult situation for us. You try to keep your anchor with someone. So that's why the exchange rate is fixed with the U.S., but we are in China. So that is a very tough situation, right? Yeah.
I think, just based on everything that we've talked about thus far, we're starting to see so many layers of embed and the matrix upon which, central banks need to consider political uncertainty, U.S. trade, geopolitical situations, not just with the U.S. and China, and all of those aspects really kind of combine into this matrix of which we try to, talk about it in terms of economic outlook. And then on top of that matrix, now let's talk about big tech. When we talk about even just this dynamic of a strong US dollar, the currency manipulator label that China has been sensitive about, and really monitoring the situation. Now, amidst all of this, we have potentially a private sector-led global currency. Facebook announced Libra followed by Mark Carney, the outgoing Bank of England governor, basically saying that there needs to be a global digital currency, synthetic hegemony, that he characterized it as. And then, of course, PBOC, with word that for the past couple of years, and that certainly has, the pace of that has increased after the announcement of Libra, working on a central bank-backed digital currency. So let's talk about all of that. I think, Chicago booth certainly has this thought leadership with Geeta Gopinath in a recent op-ed, in fact, kicking off 2020 this year, talking about potentially the need for a global digital currency from his now role at the IMF. I'll let you, how do you regard it? As former Federal Reserve Governor, once upon a time, this was the stuff of science fiction, and now it's here.
Yes. Yeah, you would sort of talk into your watch, and people would be able to, everything would be in your watch or in like a phone or something like that. Now that it's actually here, and yeah, it's very interesting that Geeta has just written about this. Not only she's Brent's co-author, but she started her career at Chicago Booth, and now she's the chief economist at the IMF. And interestingly, she was very critical of the approach that Mark Carney has taken, saying that central banks should be doing this. They need to have more efficient payment systems. They should be getting ahead of the curve and do this. And this would also provide an alternative for the dollar. But she said she really doesn't think this is something that's very sensible to do. We don't need to have the digital currency. We need to kind of get the basics of central banking right first, and then we'll worry about efficiencies of payment systems and other issues like that. So when I left the Fed, just after in 2009, just after the global financial crisis, that was soon after Bitcoin was created, and there was a lot of discussion about it at the Fed. We weren't quite sure what to make of it, and actually one of the great things about my having been there and then come back to teach is that I've been teaching about that in my money and banking class since I started teaching again in 2009. So now everyone knows what Bitcoin is, but back, it's hard to believe, but back in 2009, 10, 11, 12, no one had really heard of this. It was something completely new, or just a few aficionados knew about. In principle, as you said, it's like science fiction. It's fantastic for a money and banking professor because you can come up with all these crazy examples that you want to test students' ability to think in a new context. But this was a real context rather than a sort of a totally made-up context, even though it sounded like one. And so, I think central banks trying to promote more efficient payment systems, super important. There's a lot of money that is spent on cross-border transactions that are slow, expensive. Actually, Bitcoin does not do a very good job of doing that. In the economic outlook in Chicago that we just did last week, Austin and I were talking about this, and Austin related a story about how there's a Bitcoin conference that found it so frustrating that it was so expensive and slow to use Bitcoin is they refused to accept it. So they have a Bitcoin conference, they didn't even believe in it because it hasn't really fulfilled its promise. Now that doesn't mean that it can't. And so that's why potentially something like Facebook with Libra, they have an installed base of 2 billion people globally. They have a lot of people whose families are dispersed around the world, like many people from Latin America and the US, who then send remittances back to their family members in their home countries. They connect through Facebook, so it'd be natural to use that. And it's interesting, that's when all the regulators, everyone has gotten very, it's now a big thing and a very dangerous thing. Because there's potentially more competition there. Yeah. Because Bitcoin has proved to be really kind of something that's more for aficionados. But if you have a 2 billion people installed base and a very clever organization like Facebook, that potentially could be much more challenging. You've seen such a strong regulatory and political reaction that I think it's not going to be Facebook. I think it's going to be very difficult for Facebook to be able to go ahead as they wanted. But it does suggest that I think there's a lot of potential that's there. All the emphasis has been on the risks and the downsides, but there is a good use case for global payments that are cheap and efficient. So far, these structures haven't achieved that. Should that be done by the government? Or should that be done by the private sector? People are going to debate that. My preference would be to have things more on the private sector side and have different models to try to get to that solution. But I think that's going to be one of the really big issues over the next decade that central banks are going to be facing, and particularly if the People's Bank of China moves in that direction. Because unlike most other countries, if the People's Bank and the Chinese government say we want to eliminate currency, they can do so.
Yeah.
And can enforce that. It would be virtually impossible to do that in the United States or in Western Europe. So we may well get a very interesting experiment about how valuable that efficiency is. We won't get a test of the willingness of people to give up currency and give up that anonymity, because that's something that the Chinese government can basically enforce. Oh no, there's no anonymity. You're all in the system that the People's Bank observes of every single transaction you do.
Well, what do you think the reaction would be? And I want to hear from all of you. What would your reaction be? What do you think the reaction would be if PBOC does launch the world's first central bank-backed digital currency? Does it shift trade dynamics?
So, I mean, can't directly answer that question. I won't directly answer that question. Let me indirectly, though, describe why I think there are real obstacles to digital currencies, gaining the kind of share that we currently see currencies like the dollar having. There's a dynamic that was at the heart of, for example, the op-ed that Gita wrote that you described. Let me kind of walk through this dynamic. Imagine, for example, you're a importing country, and the goods that you're importing, just take as given, are denominated with their prices in dollars, and it's a sticky price. Well then, since you care about your purchasing power of those dollar-denominated imports, well then you probably want to have a large share, at least some chunk of your saving, stored in dollars, invested in dollars, dollar bank accounts, dollar corporate bonds, etc. Given you've got that added interest, you want those dollars on your asset side, you're going to try to entice someone to offer them to you. So your corporations, knowing that you'll accept a slightly lower interest rate on those dollar bonds, might choose to write their bonds in dollars and issue them to you. It's cheaper for them to borrow that way. But now the corporation has to pay all these dividends or interest payments in dollars. Well, they would love to have a revenue stream then in dollars. So they price their exports in dollars, which of course become the imports that we started this cycle with. And the only reason I mention that in this context is there's some real momentum, some real coordination from having such large shares in these various markets that causes a feedback and makes it hard to break from that equilibrium. It's certainly not impossible to break from that equilibrium, and I think Randy made a really interesting point about China potentially being able to create this experiment in a way where other countries wouldn't, given the dynamic. But I'm quite sympathetic to the power of that dynamic that I just described, and in that sense, am sympathetic to the op-ed, which sort of argued we still might be quite some time away from mass adoption of such a change.
Yeah, I think a currency is useful as a trading tool if someone is willing and wants to trade with you and is willing to hold that currency. Now, willingness to hold that currency is what Brent talked about. Whether you want to put 1 billion blockchain, PBOC, electronic currency in your account, right, on your cell phone. Do you want to do that? Now, what happens if the policy governing the value of that currency shifts? So at the end of the day, it will depend on the credibility of the issuer at the end. The credibility of the issuer, the willingness of other people who want to trade with your country who issues that currency. Now, as we have known, for a very long period of time, a lot of people have been willing to use the US currency. So whether it would be globally acceptable depends ultimately on the behavior of the PBOC and the attractiveness of goods and services and investments and attractiveness of all that. So that ultimately depends on whether China becomes a very attractive economy for people who want to do business with. The other thing is, even if you couldn't do it on an international scale, you could probably enforce it within your own country, right? So domestics have to trade in this digital currency. Now they have no choice and no option. But then if your domestic economy is not closed but needs to trade with someone outside the world, those individuals and those firms or units would have to hold some foreign currency. Now the value of that foreign currency is that your identity is in that sense unknown, right? I mean, what your PBOC blockchain currency's great value is that, you know, every transaction is false, so there's less fraud, you know, you would not commit a crime paying with that digital currency, right? I mean, that's the whole idea. But then you would do that with the foreign currency. And access to foreign currency will always be available unless you are a closed economy. Now, so I think there are substantial gains for China to go onto that currency, but it also depends on how others view the value of your currency and how your own people wish to hide your transactions from the state. So within China, there will be demand for currency, and outside, not everyone would want your currency. So I think it will be, but still, the benefits within China for wiping out fraud will still be very significant for a big swath of that society. But then you'll be you have to police very carefully foreign currency holders. Now that could be that could incur enormous regulatory monitoring costs too, right? So now, since this is still science fiction, you know, it's storytelling. It's not really there. We will have to see how it happens. But I think I think China is going in that direction regardless, right?
Let's open it up now to the audience. Your perspectives, your concerns, economic outlook in 2020. We have a microphone here. Just raise your hands. Thank you.
And if you could introduce yourself, that'd be terrific.
My name is Daniel Lee. I'm a digital investor. Can you comment on the trends on the equity market? Seems like, you know, no one is worrying about the risk, and we're seeing that equity market is going up and up and up, no matter what happened in the world. So what's happening there?
Buy. That's the thing. So you know, when we were together a year ago, everyone was going sell. And so I think there are very important behavioral elements that are there. And you know, and I think when I did the outlook here and both here in Chicago and elsewhere, people thought I was being sort of Pollyannish and saying, oh, because people were certain, because the stock market had gone down, that the economy was going off the cliff. And you know, the stock market goes up and down quite a bit without having any impact on the real economy or telling you about where the real economy is going. Ultimately, if the real economy is doing badly, the stock market is not going to do well in the longer run, but in the shorter run, there's not this tight, like month-to-month or quarter-to-quarter correlation. So clearly there's a lot of optimism that's there. I mean, the stock market is now, no one would have predicted that the stock market would have one of its best years ever in so many countries, whether it's in China. They had roughly a 30% increase. We had a 29% increase in the US. No one would have thought that at the beginning of the year. So one, it's really difficult. It's even more difficult to predict the stock market, I think, than in the relatively short run than it is to predict the macro outcomes. And but one of the things that I become concerned about is when other people are not concerned. And so now people just seem to push off, well, so there are these trade tensions. Well, they seem to be resolved and they're going to go in a good direction. Oh yeah, we'll come down a little bit because the tariffs weren't eliminated, but that'll be fine. You have a lot of geopolitical uncertainty in the Middle East, for example. And you get sort of retrenchment for a day or two, but I hear the pundits on Bloomberg and CNBC saying these are all buying opportunities. So if there's any negative shock and so people become negative, then you buy because we know the stock market will come back. Well, that worries me because it reminds me of a narrative that I heard when I was back at the Fed about you can always buy houses because housing prices never go down. So, buy on the dip. Unfortunately, people bought on the dip and then things went down. So I think the key. So I see a little bit of an exuberance and a little frothiness that's there because I think people are so optimistic. The fundamentals, I think, are still solid for most of the major economies of the world, and even Japan, where they've, I mentioned they've not been able to fight the deflation. The unemployment rate is still quite low. The economy, when you adjust for the reduced size of the workforce, when you adjust for the shrinking population, actually was doing okay. Not gangbusters, but doing okay. And so I would just be, I'd be cautious about thinking that, well, just because the market has gone up, it should go up more. I think I hear a lot about that. Just like when a year ago when the market had gone down, it was clear that the market should go down more. I'm not that kind of momentum investor. Maybe in the very short run that happens, and I know some of my colleagues do research on that. But I think it's harder to say about that for the long run, and I'm very much a long run investor rather than a short run investor.
Hi. Oh, wow. Nice. My name's Gordon Sanders. We've got a property market that's tied directly toward the free money in China. We have a monetary system in Hong Kong that's tied directly to the US dollar. There's no benefit to somebody's flat rising in price if you only have one flat. However, we're all concerned about the flats going up because there's no penalty to buying and holding and having 10 empty flats. How are we going to rebalance this where flats are not 21 times the mean salary in Hong Kong?
Richard, I think you should.
Richard.
Make it 22.
Well, 7 months of riots will shake it down a little bit. The question is, how do we get prices down? I don't think that's would be an objective. The objective is, how do you supply housing to the population, right? How do you get people? Now, there are two issues with housing. One is for shelter, the other is for savings and accumulation. Now, in Hong Kong, unlike for most periods of US history, as the economy got wealthier, in Hong Kong and in the US, as the economy got wealthier, the US homes got bigger houses. We got more expensive but smaller flats, right? This is the Hong Kong. Now, the whole issue is supply. Now, the problem with supply, if you look purely at the private sector, right? Ignore the public housing sector because 55% of people live in the private housing sector. For a very simple idea is basically, I think we could go back to a Chicago graduate called Ed Glazer, who unfortunately no longer teaches in Chicago, has shown that the most difficult thing with the supply of housing is the regulatory cost of getting virgin land to become land that is being zoned for planning. So you got to get the planning thing done. Then you got to overcome the building codes, and then you have to overcome the opposition for everyone who can oppose you. By the time you get through all this, if it normally takes only 2 years to build a house, it's already 6 years. Now, actually, it's not the construction cost because you can now have MIC construction in Hangzhou and ship to Hong Kong and just assemble it. It takes 3 days to assemble a floor, right? And it's all prefabricated. Hangzhou is building houses that is being shipped to London.
Wow.
Right? So it's not the construction issue, it's the regulatory issue. Now, Hong Kong has incredibly complex regulatory issues, And despite, freedom and democracy is good, our system has actually opened up compared to what it was, say, 25 years ago, and everyone can object, right? And there is no restriction on what you can not object against, right? I mean, you can object against anything, it blocks my view, I don't like the smell, So this delays it enormously. And the great challenge in Hong Kong is one more thing. The city is actually very, very compact already. The only land is in the new territories, significant amounts of land. Unfortunately, 40% of the land is zoned as country park, right? Cannot be redeveloped without a change in legislature, which is extremely difficult. And the other thing is land in new territories is primarily agricultural land, which means the only way you can develop that land is to solve all the planning, zoning, building, and all the objections. And most of that land has scattered ownership. That means it has to be assembled. Now, so what is the solution for all this? I don't know. I've been taught to analyze the problem. Now, I can suggest a very small fix if I still have 1 minute, right? A small fix. I mentioned there's not only the private housing sector, there's an equally large public housing sector. The public housing sector is dominated by rental housing, which means if Randy gets assigned that house and because he is income eligible, he lives there forever, and there is no market in public rental housing, so he cannot move. He's stuck there, right? This is going back to serfdom, right, in that structure. Two, he cannot rent it out because he rents it from government, so he has no transfer rental leasing rights, right? So he's stuck there, and if his income rises over time, you have to pay double rent, right? But fortunately, his income is always quite low, so it doesn't. But as he gets older, his children becomes employable, and when they get job, it guarantees your income has broken the eligibility. So what does that do? Well, the children move out, but they are low income. So what happens? They go in, public rental housing cannot be subdivided. Public ownership housing cannot be subdivided. Private housing that owned by an owner-occupier is unlikely to subdivide. So only the tiny little private rental housing market, which is only 15% of the market share, has to absorb all the demand from these the people. So there is also a reform dimension to it. If we actually sold or give away all that public rental housing to the sitting tenant, that market will emerge and reallocation will occur. So you don't need to build, and as a result, I actually done that analysis empirically, with Chicago taught skill. Actually, a lot of people will move back to the public rental housing if they own it, or if their parents own it. And subdivided housing demand will come down, and that will lower the rents. And at least from an investment perspective, it might slow down. I don't mean it will drop it, This is still a small slow down the rise. So unless we solve regulatory areas and policy areas, I don't see anything will be done. Yes.
Well, let's move on to we have to move on to some other questions.
Right over here. This hand.
Hi, Gary Chan, alumni, also
Okay, sorry.
portfolio manager. So there was a lot of talk about low unemployment rate, lack of inflation, I think in the U.S., elsewhere. I think behaviorally, I think also the lack of inflationary expectations. So perhaps a question to Randy. I know there's a lot of debate within the Fed about the Phillips curve being flatter now than it was before. What is your thinking about how they would adapt or adjust to this reality and use the Phillips curve with the new version of Phillips curve going forward?
So it's interesting. The Phillips curve is the supposed trade-off between a real variable unemployment and a nominal variable inflation. And what's interesting is that Milton Friedman, many decades ago, actually now more than 50 years ago, issued a very fundamental critique of the Phillips curve. And in some sense, it's come to be true that the basis of the Phillips curve is that, well, if you have some inflation, you kind of trick people because they don't know what the prices are, and so they don't realize the inflation is coming, so they accept a wage that's lower than they otherwise would if they had all of the information. So it's actually very much based on behavioral sorts of things. And Milton said, no, that's nonsense. You can fool some of the people some of the time, but you can't fool all the people all the time. That is, systematically exploit this information advantage that the central bank is going to raise inflation above what people expect. And so people have locked in a 2% wage increase, expecting 2% inflation when they really should expect 4%. But I think one of the things that has happened is that information asymmetry is much less than it used to be because of technology. I mean, one of the pieces of research that, or data sources that Brent has worked on is this billion prices project. Now, I told you Brent's brilliant at finding data, but if the technology weren't there, he works really hard, but he couldn't find a billion prices. But he can scrape a billion prices, but like every minute, basically, or every month. So you know what the prices of everything are super quickly. So you have a lot more information than you used to have. And I think that's one of the reasons why we've seen this less trade-off, because I think it's harder for that kind of trickery to occur, that central banks move ahead of where people's expectations are, because it's just too easy. People are always shopping on the internet. And in many of these sites, if you're selling something, even if it's hundreds of dollars, but you're 2 cents lower than someone else, you get all of the business. So people are really monitoring for that. And so I think there's a behavioral change, or at least an information, ease of getting information that reduces that asymmetry, that makes it more difficult to exploit that so-called Phillips curve trade-off. Do central banks fully understand that? I don't think they fully do, and this is a hypothesis. It's difficult to test, although my guess is someone sitting next to me will be able to figure out how to do that pretty soon. But I think it's a contributing factor, and I think central banks know that kind of trade-off is not really there anymore, or doesn't seem to be there. One of the debates is, would it come back in certain circumstances? I don't know. And I also think that's interestingly related to the digital currency debate. And so if everyone is just kind of plugged into the same network on numbers, that may make it easier globally, especially.
Robust conversations. I think we've run out of time. It's 8:30 now, but let's continue this conversation amongst the crowd as you network, and certainly our panelists. But what a robust discussion from last year's 2019 economic outlook to 2020 economic outlook. We're talking about, once again, US-China trade relations. How is it going to evolve over the next 10 months? Will we get to a phase 2? What will the debt piles look like? Will we get more negative yields, or will we get a rate hike to be determined by potentially the impact of big tech? And to our panelists tonight, I thank you all, and thank you as well.